Today, we're diving into a topic that's not only essential, but possibly life-changing for anyone involved in investing: what to do during a stock market crash. We'll reveal Warren Buffett's advice on navigating crashes, his proven approach, and most importantly, the one costly mistake he urges everyone to avoid. Crashes are daunting, and it's natural to feel uncertain about what steps to take. But Warren Buffett's approach is rooted in practical, timeless wisdom. If you're here to learn how to stay strong, avoid panic, and even find opportunities in uncertain times, you're in the right place. Before we dive in, don't forget to hit that subscribe button if you're new to our channel. It's a simple way to support us, and it truly means a lot. So let's get started. Stock market crashes aren't random. They're often set off by a combination of economic triggers, global events, and shifts in investor sentiment. For instance, economic crises like recessions create widespread fears about the future. Events like wars, global pandemics, or political instability can shake investor confidence, resulting in a sell-off mentality. Inflation spikes or unexpected interest rate changes can also stir fears of a weakening economy, leading investors to pull back. When many investors act out of fear, selling their shares quickly, it triggers further price drops. This creates a snowball effect. Prices plummet, leading others to panic and sell as well. It's a cycle that quickly results in a market crash. Warren Buffett has a unique way of viewing stock market crashes. Where most investors see fear and potential loss, Buffett sees opportunity. His approach is rooted in value investing, which is all about looking beyond the day-to-day price fluctuations and assessing a company's actual worth. He famously advises, "Be fearful when others are greedy, and greedy when others are fearful." This quote underlines his belief that while others panic, a disciplined investor can find great deals. Buffett's approach encourages people to stay calm, maintain a long-term perspective, and understand that market downturns are natural parts of the market cycle. Panic is natural during a downturn, but it often leads to poor decisions. One of the biggest mistakes investors make during a crash is panic selling. By reacting emotionally, investors often end up selling stocks at low prices, locking in losses that might have been temporary. Buffett encourages us to take a step back and understand that these downturns, while difficult, are often short-lived in the larger picture. The stock market, as Buffett says, is designed to transfer money from the active to the patient. His focus on patience reminds investors to view their investments as long-term commitments rather than short-term gambles. He stresses that those who can stay calm and hold on to quality stocks through downturns often benefit the most. For Warren Buffett, a stock's price isn't always a reflection of its true value. During crashes, prices might drop significantly, but this doesn't necessarily mean the underlying business is weak. Buffett teaches us to focus on the fundamentals, which include things like a company's earnings history, debt level, competitive advantage, and market position. When you focus on the fundamentals, you can see beyond the temporary fluctuations in stock prices and recognize the true value of a company. Buffett himself often views these low prices as opportunities to acquire shares in strong companies at a discount. His principle, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price," emphasizes the importance of quality over temporary price drops. Buffett's approach is famously long-term. He compares investing to planting a tree. Its benefits come with time and patience. Unlike many investors who are quick to sell during downturns, Buffett approaches his investments with the mindset that they're for the long haul. This long-term outlook allows him to withstand short-term volatility and focus on the eventual growth and recovery. For everyday investors, Buffett's advice is to maintain a similar mindset. Crashes may feel unsettling in the short term, but history shows us that markets generally recover. The average investor can benefit greatly from a long-term perspective, realizing gains as prices stabilize and begin to grow again. The worst mistake, according to Warren Buffett, is selling during a market crash. When people panic sell, they lock in their losses, potentially undoing years of accumulated growth and missing out on future gains when the market rebounds. Buffett's own actions during crises highlight this principle. During the 2008 financial crisis, instead of selling his holdings, he bought more stocks, especially those of high-quality companies. He understood that the downturn was temporary and that strong companies would recover over time. Selling in a crash often means missing out on the recovery. Buffett knows that while downturns are inevitable, recoveries are just as common. By holding on to his investments, he positions himself to take advantage of the upturns that follow a crash. This approach allows him to benefit not only from the rebound in prices, but also from the dividends and other benefits that come from being a long-term shareholder. One of the challenges of avoiding panic selling is managing emotions. Buffett often says that investors need a temperament that neither derives great pleasure from being with the crowd nor against the crowd. During a crash, fear is contagious. News channels, social media, and even family and friends can fuel anxiety, making it hard to stay calm. Buffett's advice is to train yourself to focus on the long-term picture. If you've invested in quality companies, temporary price drops don't change the company's fundamental value. By avoiding panic selling, you allow your investments to recover along with the market. One of Warren Buffett's best-kept secrets for market downturns is his war chest of cash reserves. Buffett keeps a sizable amount of cash on hand so that when others are selling, he has the funds to buy. This strategy allows him to make purchases at lower prices, often acquiring high-quality stocks at discounted rates. For everyday investors, having cash reserves means they can seize opportunities without needing to liquidate other investments. Buffett often views cash as a means to be flexible. By having this reserve, he's prepared to make smart purchases when stocks are undervalued. Building a cash reserve doesn't require millions. Start by setting aside a percentage of your income each month, specifically for investment opportunities. Gradually, this fund will grow, providing a cushion you can draw from when market prices drop. This buffer not only offers peace of mind, but also positions you to take advantage of market downturns. Investing with a cash reserve aligns with Buffett's philosophy of being greedy when others are fearful. This reserve gives you the freedom to buy into strong companies during market lows, setting you up for long-term gains when prices recover. Diversification, a buffer against market volatility. Warren Buffett has a nuanced view of diversification. While he's known for making focused investments, he acknowledges that diversification can benefit everyday investors, especially during uncertain times. By holding a mix of assets across sectors, investors reduce the risk associated with downturns in a single industry. For instance, during a crash, tech stocks may plunge while consumer staples or healthcare stocks remain relatively stable. By diversifying across sectors, you minimize the impact of a single sector's downturn on your entire portfolio. Practical steps to diversify. To effectively diversify, include a mix of stocks, bonds, and even index funds, or ETFs, in your portfolio. Index funds, which represent a broad market range, provide built-in diversification, spreading risk across many companies. This kind of diversification provides stability and the potential for growth across different economic conditions. Buffett's strategy is to balance his focus on specific companies with a diversified approach, particularly in his insurance company's investment portfolios. This helps protect his investments from the full impact of a market downturn while maintaining opportunities for growth. Controlling your emotions during market volatility. Warren Buffett often emphasizes that successful investing isn't just about intellect, it's about temperament. During market downturns, emotional discipline is crucial. Buffett believes that one of the most important traits in an investor is the ability to remain calm and rational, even when others are panicking. The phrase, "the stock market is a device for transferring money from the impatient to the patient," highlights the value he places on patience and emotional control. When markets are turbulent, the ability to avoid impulsive reactions can help investors stick to their strategies and avoid costly mistakes. Developing emotional resilience. Building mental resilience isn't easy, but it's essential for successful investing. Buffett suggests treating stocks like long-term projects or assets, not items to flip or trade quickly. This perspective encourages a focus on growth and stability rather than momentary gains. By adopting a mindset that views a crash as a natural part of the market, you can better handle emotional impulses. A strong mindset will help you maintain confidence in your long-term investments, allowing them the chance to recover and grow beyond the downturn. Step 1. Stay informed without overreacting. When markets are in decline, the abundance of news and social media can heighten anxiety. Buffett's advice here is simple. Stay informed about the companies you're invested in, but don't let daily headlines drive your decisions. Focus on the business's performance rather than reacting to stock price movements. By keeping a level head, you make investment choices based on reliable information and avoid the pitfalls of reactionary decisions. Step 2. Reassess your portfolio strategically. A market crash can be an ideal time to reassess, but it doesn't mean an automatic sell-off. Instead, look at your investments and consider whether they align with your long-term goals. Some companies might no longer fit your strategy, while others may be ripe for additional investment. Buffett's portfolio is constantly evolving, but he reassesses with a careful, strategic eye rather than impulsively. This approach ensures that his portfolio remains strong and focused. Step 3. Stick to your investment plan. Buffett emphasizes having a clear investment plan. If your plan is sound, then even a market crash shouldn't throw it off course. Adjustments are fine, but drastic shifts are often detrimental. Focus on your end goals, whether they're for retirement, income generation, or long-term growth. Market crashes are part of the journey, and maintaining your strategy will help you reach your objectives. So there you have it. Warren Buffett's time-tested approach to navigating market crashes. Remember, stock market downturns are daunting, but with a calm mind, a long-term perspective, and a commitment to your strategy, you can turn these challenges into opportunities. Thank you for joining us today. If you found this video helpful, please don't forget to subscribe. Your support helps us bring more valuable content that empowers you to build your financial future. Remember, it's your patience, discipline, and focus that will carry you through market ups and downs. Until next time, stay informed, stay calm, and invest wisely.